Hi everyone, welcome back to our channel. Today we are diving into the escalating trade tensions between the US and China and how it's impacting global industries and tech giants. Let's get started. In a bold move, Beijing has halted exports of critical rare earth minerals and magnets. This is a direct response to President Trump's increased tariffs. These materials are essential for industries like automotive, aerospace, and semiconductors. With shipments stalled, concerns are rising about prolonged delays and potential shortages. China is drafting a new regulatory system that could permanently restrict supplies to certain firms, leveraging its near monopoly on these essential materials. This disruption underscores the escalating trade conflict and its impact on worldwide manufacturing. New tariffs from the Trump administration could cost US semiconductor equipment manufacturers over $1 billion annually. Major players like Applied Materials, Lam Research, and KLA could each face losses of around $350 million per year. Even smaller firms like Onto Innovation are projected to incur millions in additional expenses. These tariffs are expected to hit advanced chip manufacturing equipment hard, crucial for global production. The burden includes lost sales and increased sourcing costs, following prior revenue losses due to export controls on equipment to China. In a surprising twist, Goldman Sachs economists briefly predicted a 65% chance of recession within 12 months due to these tariffs. But just over an hour later, they reversed their forecast after Trump announced a 90-day pause on new tariffs for most countries. While maintaining increased tariffs on China, Trump offered temporary relief to over 75 countries. This rapid turnaround highlights the volatility of US trade policy and its significant impact on economic forecasts. Experts warn that uncertainty may linger despite this temporary pause. OpenAI is reportedly developing a generative AI-powered social media platform, potentially competing with Elon Musk's X. This internal prototype features a social feed integrated with ChatGPT's image generation capabilities. CEO Sam Altman is seeking feedback on this early-stage concept, positioning OpenAI against both X and Meta, which is also exploring AI-driven social products. This development comes amidst a legal battle between OpenAI and Musk, who recently sued the AI company. Meanwhile, the Trump administration is considering sanctions on Chinese AI firm DeepSeek over data privacy and national security concerns. Allegations include using restricted NVIDIA chips and funneling US data to Beijing. With Singaporean authorities already arresting individuals for illegally exporting NVIDIA hardware for DeepSeek, the firm faces growing global scrutiny, including probes in Italy and France. This potential crackdown intensifies the trade tensions between the US and China. Let's take a look at the economic indicators for this week. Export prices came in flat for March at 0.0%, just below the 0.1% forecast. That's a slowdown from the 0.5% growth we saw last month. This suggests weaker global demand or reduced pricing power for US goods, which could contribute to easing inflationary pressures. On the import side, prices actually fell by 0.1%, surprising analysts who expected a modest 0.1% increase. This drop could reflect a stronger dollar or global disinflation trends, offering some relief on the inflation front, especially for imported goods. Now let's talk about the consumer, and here the story is a bit more upbeat. Core retail sales, which strip out volatile items, rose by 0.5%, beating the 0.4% forecast, though down slightly from 0.7% last month. This shows that consumers are still spending, a sign of resilience despite rising costs and economic uncertainty. Headline retail sales came in even stronger, jumping 1.4% versus an expected 1.3%, and well above February's 0.2%. This broad-based strength in consumer spending could lift GDP expectations for the quarter. Over to crude oil inventories. They increased by 0.515 million barrels, more than the 0.4 million expected, though well below last month's 2.553 million rise. This uptick could point to softer demand or oversupply, potentially putting downward pressure on oil prices in the short term. In the labor market, initial jobless claims came in at 215,000, better than the 225,000 forecast, and slightly down from 224,000 last time. This continues to highlight a strong labor market, with relatively low layoffs, reinforcing job stability and consumer confidence. Finally, in housing starts fell to 1.324 million, missing the 1.420 million forecast, and down from 1.494 million in February. This suggests higher interest rates or declining demand are starting to bite, which could slow construction in the coming months. Next week, market attention will be focused on key economic indicators and earnings reports, including S&P Global Manufacturing PMI, month-over-month US leading index, new home sales, initial jobless claims, and crude oil inventories. Meanwhile, several major corporations are set to release their earnings reports, including Tesla, Alphabet, Intel Corporation, Boeing Corporation, International Business Machines, Procter & Gamble, Halliburton, Verizon Communications, PepsiCo, and Merck & Corporation. That's a wrap on today's discussion. So what's the big picture? Retail data is holding strong. The labor market remains solid, but soft inflation indicators and slowing housing activity point to areas of economic cooling. Which of these trends do you think will have the biggest impact going forward? Also, what do you think about these trade tensions and tech rivalries? Let us know in the comments below. Don't forget to like, subscribe, and hit that notification bell for more updates. Thanks for watching, and we'll see you next time.